Turtle soup is a reversal mechanism. This is a change in the state of delivery, turtle soup. And then you have a turtle soup that is an entry mechanism that's part of an existing or unfolding sell or buy program. What does that mean? That means that this is a change in a directional price run that's going to most likely be sustained for a session or day or longer. The turtle soup aspect is that we're taking out the liquidity above this high and all these highs here. So the buy stops that's resting in here for anyone that wants to go short or be short, if it's not there, it's definitely above there. But how far, ICT? Well, that's the reason why you want to have these new week opening gaps and new day opening gaps on your chart. 5 weeks for new week opening gaps, 5 days for new day opening gaps. You are welcome, and I encourage you, if you can organize your charts efficiently, to do more than that. But as a baseline to start with, you'll see many really, really nice trade setups using that criteria. 5 for end dogs, 5 days for end dogs, basically, and then 5 weeks for new week opening gaps. Because the markets are going to do what with them? They're going to act as magnets. So if you have one element of turtle soup that is a change in the state of delivery that causes a directional change that's going to be sustained, okay, that's a reversal pattern, then you have turtle soups that are entry techniques that are part of an existing price run that's still yet to be completed. Meaning that we can look at all the run from here down to this low here, and anything that sees a short-term high pierced, not just by the wicks, not just by the wicks, the bodies. Well, can you think of one without having to go on to any detail further right at this moment? I want you to think about it for a second. What concept do you think would be an example, one example, of a turtle soup that's an entry technique in a trade that a existing trend or momentum or sell or buy program is underway with? Can you think about that? Institutional order for entry drill. Ooh, how about that? We have that in the form of, we have an old high here. See that? Why is this high being utilized anyway? Because it's a fair value gap. Every time I go into a short on a fair value gap, or if I go long on a fair value gap, my mind is I'm trading an inefficiency with a mechanism of entering with the turtle soup. So I'm buying below an old low. Let's say that I was seeing this at the time, okay? And I want to take a trade and I want to be a buyer. I'm going to use this candlestick here, the high. Why am I using that? Look at the wick. It's overlapping inside the top end of that candlestick. That makes that small little, I'm going to have to zoom in because if I'm going to teach it right. So we have this candlestick run up, and then we have this portion where we opened and traded down. You might look at this and say, well, why don't you have this and this? That's something entirely different. This is a normal ICT fair value gap. Just like when I teach a volume imbalance, okay? If I teach you to use a volume imbalance when there's a fair value gap in formation, that means that there's a separation between one candle body and another candle's body that is inside of the fair value gap. We don't have that here. But what do we have? We have an overlapping of this candle's high. It's all body. And then we open, we trade down. It overlaps this little portion in here. But there's no wick there. You see that? Big telltale sign. What's occurring there? It's flush and one little tap down. This is how I would classify this inefficiency. But I have to encapsulate it here because this is a balanced price range between this low and that candle's high. That is a PD array that you've never learned before. It's the first time I'm introducing it. Just like when I introduced the inception of the volume imbalance, when there's a gap, a fair value gap, you have to incorporate that because that's the real range of that inefficiency. This inefficiency here, you have to refer to that as well. Notice it doesn't even get down into that gap below right there where it was like this. There's nothing there. It's just a gap that stayed open. Yeah, wonderful. But that's not the narrative. The narrative is you have a balanced price range here inside of a fair value gap. So that's why the market goes down to that level there and sends it higher. So extending that over here, that's the range. But if you have this candlestick here for that gap from here to here, see that? That gap is part of the sell program. It's formed as it dropped. So those are going to always be the most important ones. I'm watching that because what I'm watching is I want to see, does it converge and agree with something that's over here that formed as a basis for taking a trade. Okay, let's say that we did not have this gap again, and say we didn't have this gap and this gap. What over here would be in agreement with this 6 o'clock time? Remember yesterday at 6 p.m., we have to annotate that either with the new day opening gap, if there's a distinction between the 5 p.m. closing price and the 6 p.m. opening price. We always annotate that as a new day opening gap. But if the 5 p.m. closing price or settlement price is the same as the opening price at 6 p.m., all we do is draw a single line, and you can label it whatever you want. If that's all we had there, and we didn't have the inefficiency in this form of this gap here, and we didn't have that one here, what else would be there? And let's say we didn't have this wick here. Say we didn't have that. What else, if it was retracing up, what else would I lean on? I would use this, obviously, but it could trade through them. Remember, it can spike. It can cause candlesticks like it did here to have wicks. What is it doing? Look to the left. It's part of the buy side of the curve. Isn't this a wick? See that? Here's the halfway point of that wick. That's pretty fucking random, isn't it? It went right to that as well. And even if you didn't have all these other things, if this candlestick went up and stopped short of that, that means I absolutely know with a great deal of confidence that the next candle, when it opens, I want to trade into the body of this candle. And as soon as it does that, that's going to be treated as a bearish order block. Not because it's an up close candle, but I'm trading it because it's inside of the range of that candlestick. So back to this right here. For turtle soups that are part of an existing price run, anytime you're trading in a fair value gap, you're literally trading a turtle soup. You're trading above and going short an old high, which is this candle's high. We're trading with the express purposes that there's an absence of buyers that's been afforded any opportunity to be a buyer above this candle's high. That's essentially what my fair value gap is doing. The fair value gap is this. We have one single pass. The shaded area is highlighting this candle to that low of that candle, okay? I don't care about anything else except for that candle's low because there's no volume imbalance there. See that? No volume imbalance. We're part of the sell side of the curve. We're dropping. I want to see it stay low. I want to see it stay low. So I am only interested in technically seeing, I don't really have that highlighted. I'm going to take the 6 o'clock price off, and then I'm going to add the midline on this. So all things being equal, no wick discussion. It's just this fair value gap. What we're talking about is it's part of a sell side delivery. It's part of a sell program. The market's reaching lower for sell side or a discount inefficiency. So if it's going to trade up into this inefficiency where only one candle passed, so between this candle's high and that candle's low, it only went down one time in one candle for 1 minute. That's inefficient with buy side. Buy side is where price is offered going up. Buy side liquidity is where it's reaching for while it goes up. See? I'm looking at that high right there, and I want to be a short seller generally on the fair value gap. I'm trying to put my limit order at that price or one tick above it. That's my first 6 contracts. That's my model. And then if it can trade up into the midpoint or as it starts to slide towards it, then I'll throw in my 4 contracts. That gives me a total position so far, scaling in 10 contracts. Does it go all the way to the midpoint? Does it go all the way to the top? This is permissible. Remember that term? It's something that is allowed to happen, and it doesn't change the underlying direction or where the market's going to go. It just means that this is possible to happen. It doesn't change anything. It's better, it's much better if it only goes to half or less and then does this, because that means it's really, really weak. But because I already expect it to go lower, this is just an opportunity for the market to reprice to that level right there. That candle's low. If I'm shorting a fair value gap, I want to enter at that old candle high. And by the very nature of it, that's a turtle soup. You're going short above that high. But you think this is turtle soup. Just a high, pierce above it, and then there it is. But that is true here. That's a breaker. Breakers tend to be turtle soups in changing directional sustained price runs, where you have high, low, higher high. There's your breaker, but the essence is a turtle soup. That is not what's going on when you're using as a trade entry that's part of an existing or underlying or unfolding sell program or buy program, because you're looking at one single candle like this, and you have to get above that candle. Well, how far can it go? See, it's going to be harder for you to do these entries here, because as it's going up like that, you're not going to want to stand in front of that. These are the more advanced ones. These are very, very demanding in your understanding. The fair value gap, which many of you are real accustomed to now, you're comfortable with it. What you don't realize is you're doing the same thing here. That high is here. This high is here. The difference is this is a visual aid in telling you how far this part of this run above this old high here, which is this individual candlestick. How far can it go, ICT? Where's too far? Too far is going above this candle's high. That's a stop loss. Entry here. Stop loss here. Now, that's the baseline entry strategy and where stop loss would be. Take it one step further. What is that? Let me move this out of the way so you can see. What's this part right here? Isn't that a wick? Well, let's use that information because that candle is the high end of the fair value gap. Pattern is 3 candles. It's this one. That's candle 1. Here's candle 2 and candle 3. A fair value gap, the inefficiency, is always candle number 2. Candle number 1. If candle number 1 has a wick right here underneath it, that is a premium array. That means it's it's above the fair value gap and it's trading up to here. You're thinking I'm going to get into a trade here or at the midpoint, and you want to see the upper half of that stay open. That's this area right here. So entries here, stop loss is here. That's the methodology. Okay. Advanced version. Okay. How do you mitigate underlying risk? You're watching it enter. You're thinking, okay, I want to see how it behaves here. If it goes there, I'm expecting it to go halfway, no more, but leave a portion open. But if it goes up there, then you demand immediate response where it needs to drop. Okay. If it doesn't completely come back to this candle's low and it leaves a portion of that open, that's what you want. And then you anticipate very fast speed and big, large range candles going lower. After it trades to that candle's low, once it does that, then you absolutely demand immediate response, and the same thing happens. In my videos, you'll see me say, I want to see speed and distance and large ranges going down, and then you get it. You do not want to see it book that candle's price high. But what happens if this is a little too rich for you? You don't like that. It's too much range. How can you reduce it? Well, if you have this candlestick number 1 in your fair value gap, if it has a wick like this is a premium array because it's going to be trading up to it. You don't want to see it trade there, but you can take that wick and do this. There's consequent encroachment of that wick plus 2 ticks. There you go. You're not fearful. Why would I fear this never being hit? Because it's 2 ticks above the midpoint of this. This candle opens and trades down. Isn't this overlapping that candle's low when it does this? So essentially, what is this area here? It's a balanced price range. Balanced price ranges, we don't ever want to see it go down, start here, go back over, and then come all the way back to the top. If it does that, it's probably going to go higher, and I don't want to be in that trade. So I don't need to put a stop loss up there. I can be just above the consequent encroachment of that wick because it's a gap, just like this is a gap, okay?